since we are live, we're going to go ahead and get started. Welcome, everybody, to our K-Rap Power Hour for our last playtime in February. This time we have a great lineup. But before we get started, I want to hand it over to our Madam President, Ria, to give us a few thoughts and some comments.
Welcome everyone to another amazing Power Hour. I just am so excited. If you haven't seen the messages already coming in, we're getting ready for March Madness. And part of that March Madness activity is promoting the California Dream for All program. So we're so excited for our topic today because it's right in line and what we're all getting prepared for.
All right. Thank you, Madam President. And we just want to make sure, because our power hours are exactly 1 hour long. So we want to make sure we give as much time to Miss Leanne Walker, because we are very happy to have her from Cal HAFA. Miss Leanne Walker, can you go ahead and give us a little bit about yourself? And if you want, you can start the presentation.
Okay, I'll go ahead and get here to share my screen. And see that. Okay. Hopefully everyone can see my screen. Good afternoon. I'm Leanne Walker with Cal HFA. I've been with Cal HFA 21 years, and I'm the training and outreach specialist. So I do all the training and outreach for Cal HFA through the state of California to all of our real estate partners. And I'm excited to be here today to give you guys information about Cal HFA. Hopefully most of you have heard of us, but for those of you that have not, we've been around since 1975. We are the state of California, so we are an actual state agency, but we've been around since 1975, providing down payment assistance for first-time homebuyers here in California. So our focus is on low to moderate income families here in California. But you'll see our income limits are actually pretty high to be a low to moderate program. Since we are the state of California, the borrower does not apply directly through us. They'll go through one of our approved lenders, which you can find on the website. We have about 140 approved lenders. And then also we have brokers that can broker through our approved wholesale lenders as well. So there's a lot of options for borrowers to apply to get access to our program. I know everybody wants to hear about Dream for All. I am going to cover that, but before I get into Dream for All, I do want you guys to realize that we do have our regular products that are available year round. So even though we're a state agency, we are an actual state, a self-funded state agency. So My Home comes from our own funding, so there's always funding available. Dream for All does come from a Senate bill that got passed with the state budget. So the state gives us a certain amount of money for that program. And once that money is gone, the program is gone. So I just want to make sure everyone understands the difference. We're just basically the administrator for Dream for All. My Home is our actual product line. So there's always funding available. So if someone is ready to buy right now and they don't want to wait for Dream for All, My Home is available, or if they want to wait till next year, My Home is going to be there. So My Home has been around since 2010. So we always have funding for some type of down payment program. So My Home is going to cover that minimum down payment for the borrower. So we offer all the first mortgages, FHA, conventional, VA, USDA. Of course, the two most common are going to be FHA and conventional. So FHA requires 3.5% down. My Home will cover that full 3.5% down payment. On conventional, as long as it's within the conforming loan limits, our conventional requires 3% down. My Home will cover that full 3% down. So My Home is going to cover the minimum down payment for the borrower. The only time My Home does not cover the full down payment, if it is what we call a high balance loan. So where the loan amount is over the conforming loan limit of $766,550, then 5% is required down. And My Home still only gives 3% on conventional. So that's the only time that a borrower would have to come in with any additional money. But other than that, My Home covers that minimum down payment. My Home can be used for closing costs as well. So it is flexible, but most people use it for down payment. So the borrower would just come in with their own closing costs or get help from the seller. But My Home, I think, is a great program. I actually think it's better than Dream for All, but of course, it's not giving the full 20%. So some people need that bigger down payment. And then My Home is flexible to where the borrower can bring in any amount of their own money and combine it with My Home. And that's what we're seeing right now in this market with the rates still being up and the prices being up. Some people need more than the minimum down payment to be able to qualify for what the sales prices are going. So that's what we're seeing a lot right now, where borrowers have been saving up. So they'll use some of their money and combine it with My Home to get a bigger down payment. So that is an option as well. My Home is a loan, so we want to make sure the borrowers do understand that they do eventually have to pay this back, but it's silent. There are no monthly payments. The lender does not have to calculate a payment into their debt ratio, but it is due and payable whenever they sell the property, refinance, or in 30 years, whichever comes first. So we want to make sure they do understand that it's not a grant. So they do have to pay this back, but it's silent. There are no monthly payments, but they can make payments at any time and they can pay this off at any time. There's no prepayment penalties. And it does come with a 1% simple interest. So it's calculated on a simple basis, so it's not compounded. So they're going to know every year what the interest is being added each year. So My Home, I think, is a great program. So just keep that in mind that we always have funding available. This is why we have it as a loan, because it's recycled funding. It's there to help someone in their time of need. And then when they go to pay it back, it goes back into our pot of funds to help another family. So that's why we always have funding available. Now, we allow the lender to do all the credit qualifying, but we do have some minimum requirements. So we do have a minimum credit score. So for the government loans, 640 is the minimum credit score. For conventional, 680 is our minimum credit score. We will go down to a 660 on conventional if they are considered low income. So that's if they meet the 80% AMI home ready income limit. We do have a max debt to income ratio of 45%. If they have under a 700 credit score, we will now go to a 50% DTI only if they have a 700 or higher credit score. So that is something new for us. We changed that about a year ago. We've always been really stuck at that 45 because our goal is to help someone get into a home and keep them in the home. So we want to make sure that they are not overextended, that these borrowers can truly qualify for this property. Their only issue is that they just needed some help with their down payment. So again, we're not trying to set someone up to fail. We want to make sure that they truly do qualify. But we know everything is so expensive right now. Rent is going up, gas, groceries. So it makes it hard for people to save up for their down payment and maybe be within that 45 max DTI. So our thinking is someone who has a higher credit score can handle a little bit more debt. So that's why we'll now go to a 50 if they have a 700 or higher credit score. But this is the absolute max. So we feel anyone that has a lower credit score than this or a higher debt ratio, that they may not be mortgage ready. So we want to make sure these are mortgage ready borrowers. They just needed some help with their down payment. We have a first time homebuyer requirement, and that is that they haven't owned their primary residence in the last 3 years. That is going to change a little bit on Dream for All, and I will cover that. And then we do require that the borrower go through homebuyer education because we want to make sure these are educated homebuyers. We only require one borrower on the loan to do the counseling. They can do online through a company called eHome, or they can go in person or virtual through any NeighborWorks or any HUD approved 8-hour course. Once they complete the course, they will get issued a certificate. It's good for 1 year. So we do recommend if the borrower is, definite that they're going to buy in the next couple months, we recommend they do this now. But if they're not sure, maybe wait, because if they take it now and they wait a year, they're going to have to retake it again. And most of these do cost money. So again, that's why we're trying to keep the cost down and only require one borrower on the loan to do the counseling. And then we do have income limits. Now, I know everyone's probably listening from all over the state. I just listed here in Southern Cal. I'm not sure where everybody is located. Sorry, I didn't have time to switch out to do Northern Cal, even though that's where I live. But I'm in Southern Cal right now. I'm doing other events. So you can go on our website and get a list of all of the counties. So remember, we are the state of California. So someone can use our program to buy anywhere in the whole state. So they're not limited to certain cities or certain counties or certain areas. They can buy in the whole state. These are just some of the SoCal counties. So LA County, they can make up to 194,000. Orange County up to 253,000. So you can see our income limits are actually pretty high to be a low to moderate program. And we go by the income that the lender uses to qualify. So as soon as the lender qualifies the borrower, they're going to be able to look at their income and check our income limits to make sure that they meet the income limit for the county that they are buying in. And we only count the income of the purchasing borrower. So we don't look at household income. We only count the income of who's actually buying. And then I don't have it on the screen, but our programs are meant for a single family, 1-unit property. So it's not for multi-units or duplex. It's for a single family, 1-unit. Accessory units are okay as long as the appraisals comes back saying it's a 1-unit with an accessory unit, and it's not saying that it's 2 units. So those are the guidelines for my home. So I'm going to jump into Dream for All. And again, I'll answer any question anyone has at the end. So Dream for All is a shared appreciation loan. So that is one thing we want to make sure the borrowers understand that. There is an additional homebuyer course that the borrower has to take. So in addition to the regular homebuyer course, they have to take a second one that goes over the shared appreciation. Because we want to make sure these borrowers understand what a shared appreciation loan is. So that way they know what they're getting into, because it may not be the best option for them. It's a great program, but it's not going to work for everyone. So we want to make sure that they do understand. And we also recommend that all of you take it. So all of our real estate partners take that course. It's on our website. It's free. Maybe it takes about an hour or so, but it's just good information. So we recommend our real estate partners to take it. So that way they better understand and communicate that with their clients. But what the Dream for All is, it did come from a Senate bill that got passed with the state budget. So again, it's not CalHFA's funding, it's coming from the state budget. So since we are part of the state of California, and we're the housing agency for the state, whenever there's any type of housing or Senate bill that gets passed, the state will ask us to administer the program. So it's a 20% down payment. It's on conventional loans only. So this is one reason why we did come out early. First round of Dream for All that happened at the end of March, beginning of April of last year, we got 300 million for that round, and that 300 million went in 11 days. So it was pretty crazy. It went really fast. So anyone just finding out about it, by the time they even started, the funds were gone. So we did make some changes to make it fair across the board. And we are coming out early with the guidelines because a lot of guidelines have changed. And some of these changes will disqualify a lot of borrowers. So we don't want a borrower to wait until April and then find out they don't qualify. So that way they know now if they're going to meet these changes and if it is going to be the best program for them. We still tell borrowers not to wait and still apply through one of our approved lenders and get pre-qualified and see if maybe the My Home could work for them or another program like the city or county programs, because it's not guaranteed that they're going to get the Dream for All. So we're telling our lenders, see what the borrower can qualify with first. If this is the only option, just as long as they're setting clear expectations that there's no guarantee. And I'll get into that because it's not going to be first come, first serve anymore. So it's a 20% down payment program. Now, one of the changes from round one is that we are putting a cap. So it's 20% of the sales price or appraised value, or 150,000, whichever is less. So what that breaks down to is if the sales price is 750,000 or less, then they will get the full 20%. If the sales price exceeds 750,000, that's when they will be capped at the 150,000. So 20% or 150,000, whichever is less. Now, if they are getting the full 20% and they use that for down payment, it avoids the mortgage insurance. So that's why this is a great program and a lot of people are interested in, because on conventional, you put 20% down. It does avoid the mortgage insurance. And we know mortgage insurance, that could be a good amount, could be several $100s a month added to their mortgage payment. So that's already eliminating that mortgage insurance payment. Also, they can choose to use up to 5% toward closing costs. So they could put the full 20% for down payment, then they would need to come in with their own closing costs or see if the seller can give them a credit toward closing costs. But if they did need help with closing costs, they can use up to 5%. So say their closing costs are 5%, they could put 5% toward closing costs, the remaining 15% for down payment. Or say their closing cost is only 3%. They could put 3% toward closing costs, the remaining 17% for down payment. Now, they will have a small mortgage insurance payment since they're not putting 20% down. But there are options that the lender can go over with them. They can do a single premium, so use some of the money to buy out the MI. So that is another option as well. So they have those options to use the full 20% for down payment, or use some of it up to 5% to cover their closing costs as well. Now, if they wanted to bring in some of their money for down payment, we do put a maximum of 5%. So 5% is the max that they can contribute of their own funds. That includes gift funds toward down payment. Now, they can still come in with any additional money to cover their closing costs. But if they want to use any of their own funds toward down payment, 5% is the max. Now, one of the biggest changes from round one is that it is going to be a pre-registration randomized selection process. So I need to change the lottery out of there. The state keeps telling us, don't call it a lottery. And they're like, it's a randomized selection process. So basically a lottery. But now I understand, because a few weeks ago, I had a borrower contact me and said, how do I enter this lottery to win a free house? And I'm like, okay, now I understand. So no, it's not, you're not winning a free house. Nothing is free. But that's kind of what the process is. So it's a randomized selection process. So it's not first come, first serve anymore. We can't have what happened round one, it going in 11 days. So, and this is another reason too, we're, trying to get as much outreach done about the program to all of our real estate partners, including realtors and realtists. So that way they understand how the process works this time. Because some people with the first round, because the way our programs work is the borrower has to have an executed purchase contract before the lender can reserve the loan with us. So with the first round, people went and entered into a contract, opened escrow, lender went to reserve funds, funds were gone. So it left some people having to fall out of escrow. So we don't want, the real estate agents to see Dream for All and just run and say, oh no, I'm not accepting that offer. So we want to make sure everyone understands that this round is going to be different. So how it's going to work, and we haven't announced this yet, but the program is not going to launch until April. So there's going to be a portal that the borrower has to register in. So we're hoping to announce, if not the end of the month, maybe the first week of March. So we do encourage you guys all to sign up for our e-news notifications. And then that's when we will announce all the details regarding this pre-registration. But the borrower is going to still go through one of our approved lenders and get pre-approved. So we have a standard pre-approval letter that every lender is going to fill out. So the lender's going to pre-approve them just like they do any other loan. Whatever they do before they send the borrower out looking for a home. So they're going to pre-approve the borrower. They're going to fill out this pre-approval form. They're going to give that form to the borrower. Once we announce when the portal is going to be open, the borrower themselves has to go into this portal and fill out the registration and upload their approval letter that they got from the lender. Now, we don't have the exact dates yet, but we'll announce that, but it's going to be pretty much the month of April. So probably about 3.5 weeks, the portal is going to be open. Only thing I can guarantee you is that it's not going to open on April 1st. We are trying to avoid that. We don't want people thinking, oh, is this April Fool's joke? So probably a few days after that. So it will be open until the end of April. So everyone doesn't have to run out on day one to enter this portal because it's not first come, first served. So even the first person that enters the portal may not get selected. So it doesn't matter at what point, as long as it's within that registration time. So just say it's, April 2nd to April 30th. So they have that whole time to be able to register. So once the portal closes, then no one can enter the registration anymore. Then probably a few weeks after that, so probably mid-May is when we're going to do the selection. So it's going to be totally random based on the county they're in, so the region that they are located in. So if the borrower gets selected, they're going to get issued a voucher. That voucher is now going to allow them to go shop for a home. So that way, someone's not getting into escrow trying to figure out, oh, am I going to get the program or not? They're going to know prior to them shopping for a home. So they'll get that voucher. They can now shop for a home. The voucher, again, it's not confirmed, but right now we're thinking 90 days the voucher will be good for. So that's going to give them 90 days to get into contract and the lender reserve the loan with us. So they don't have to close the loan in 90 days. They just have to enter into contract and the lender reserve the loan with us within that 90 days. So that's going to give them some time because we know we're still dealing with low inventory. So it may take them a little bit of time to find a home. Now, the random selection, we are going to go by 9 regions. So we have divided the state into 9 regions, and we want to make sure it's equally distributed throughout the whole state. So we're going to issue these vouchers based on the population of that region. So, for example, LA County represents about 25% of the state of California. So we're going to allot about 25% of the vouchers for LA County. So, Inland Empire is going to be a region. So Riverside, San Bernardino, Imperial County will be part of that region. Bay Area, so Alameda, Contra Costa, those counties will be part of that region. So we're going to allot a certain amount for each region. So it's going to go by where the borrower currently lives now. So say they live in LA County now, they will be part of the LA County selection. Now, if they get selected and get issued the voucher, they can take that voucher and buy anywhere in the whole state. So we're not saying, since you live in LA County now, you have to buy in LA County. Because we understand that just because someone lives somewhere now doesn't mean they can afford to buy in that county. So they can still take that voucher and buy anywhere in the whole state. But they have to make sure that they meet the income limits of that county, because the income limits are based on where the property is located. So there's a lot of misinformation going around on social media. So that's why I tell everyone, go to our website. Don't listen to social media because people are spreading a lot of wrong information. And they're telling people, oh, you can take the income limits wherever you live now, and that goes with you. That is not true. So, for example, Orange County is expensive. So someone gets selected in Orange County, people are saying, oh, you can take the Orange County limits and buy in Riverside. That is not the case. So even though they can take that voucher and buy anywhere in the state, as long as they meet the income limits for the county that they're buying. So what we're telling our lenders to do is when the borrower applies through them, they need to be asking these questions. What counties are you looking to buy in? So if the borrower says, I'm looking to buy in LA County, Orange County, and Riverside County, once the lender qualifies them, they'll be able to look at their income and see what their income, if it meets which income limit. So they can tell them, oh, your income limits are too high for Riverside County, but you could buy in LA or Orange County. So that way they know up front what counties that they qualify in. So they can't take Orange County limits and buy in Riverside County. So the income limits are based on where the property is located. The selection of the vouchers are going to be based on where the borrower lives now. And then one borrower does have to be a current California resident. And the big one, this is where I say don't shoot the messenger, okay? This was a state requirement. This was not CalHFA's requirement, and I've been getting pretty beat up about this. One of the changes is that one borrower has to be a first-generation home buyer. Now, we were able to relax the definition a little bit because really first generation means the borrowers never owned, their parents have never owned. So we got it down to the borrower has not owned in 7 years and their parents do not currently own now. So just needs to be one borrower. All borrowers still have to be a first-time home buyer. So if there are multiple borrowers, they all have to be first-time home buyer, but only one of them has to be first generation. So again, our definition of first generation means the borrower has not owned any real estate in the last 7 years in United States, and their parents do not currently own currently. So their parents could have owned before, they just don't own right now. Now, if their parents are deceased, their parents did not own when they died. So I know that is kind of harsh. So it could be a borrower that their parents died 20 years ago, but they owned a home when they died. It does disqualify them. A lot of people, like I mentioned, are not going to meet that definition. This was a state requirement. So again, the money's coming from the state, so they get to set some of these guidelines. But we did get it down to one borrower and a more relaxed definition of first generation. 7 years that the borrower has not owned and their parents don't own now or didn't own at the time of their death. Also, a first generation home buyer could be a borrower who has not owned in 7 years and they grew up in the foster care system or they spent any time. So they didn't have to grow up their whole time, but if they spent any time in foster care and they have not owned a property in the last 7 years, they are considered first generation as well. Now, the borrower will be signing our state reporting disclosure form and also attesting to this when they do the pre-registration that under penalty of perjury that this information is correct. So we want to make sure our lenders are telling the borrowers this. This is going to be audited. So we are working with a third-party investigation company that is going to audit 100%. So they need to be truthful. On the affidavit that they're signing under the parents, it does say to the best of my knowledge. And we're already hearing that lenders are trying to figure out a way around that they're like, oh, we'll just say to the best of my knowledge. And so just act like your parents don't own. We have that there because we do understand that there are some people that maybe are estranged from their family. They're estranged from their parents, and maybe they haven't talked to their parents in years and they don't truly know if their parents really own a home or not. So they're stating under the best of their knowledge, my parents don't own. Now, it is going to be investigated, and if we do find out that their parents do own, it does disqualify them from the program, but they didn't commit perjury because they really didn't know. But for the people that we find out that committed perjury, we are going to report all of that to the Department of Justice because committing perjury is a felony. So we are taking this seriously. So we want to make sure people are not trying to tell borrowers, oh, just say you don't know. We're going to go after the lenders too if we find out that they really did know. So just make sure the borrowers are being truthful. I know there's a lot of borrowers that could benefit from this program, and this guideline is disqualifying them. We're gathering all this information. We're hearing a lot of, stories. And right now our hands are tied, but if the state were to give us more money in future years for the program, we're relaying all this information back to the state. And when we're also telling all our real estate partners, reach out to your local representatives because they are the ones making the choices for this program. Sorry that it may disqualify a lot of people, but just so you know, the reason why the state has this requirement, they are trying to help lower income borrowers build generational wealth. So they feel like if their parents don't own a home, then they don't have that generational wealth. So that's kind of what their thinking is. Also, the income limits are going to be lower. Our regular income limits go to about 150% of the AMI. The state did require us to lower the income limit, so we were able to just go down one to about 120% of the AMI. But you're going to use our income limits because our income limits, we do our own little calculation, so it actually comes out to a little bit higher if you were to go to Home Ready and look at 120%. So again, for Southern Cal, here are the limits. So where I mentioned for my home, for LA County, you can make up to 194,000. For Dream for All, it's going to drop down to 155. So again, you can go on the website and get the list of all the counties. So the income limits are going to be lower. So again, this is why we came out early with all the guidelines. So that way borrowers will know, if they are over the income limit, then that way they're not waiting till April. Also with the first generation requirement, that way, they'll know up front, okay, my parents own a home, I don't qualify. But like I mentioned, only one borrower. So if you have two borrowers buying together, they both have to be first-time home buyers, but only one has to be first generation. So example of that, say husband's a first-time home buyer, but his parents currently own a house. So he's not first generation, but he is a first-time home buyer. But say his wife is a first-time home buyer and her parents do not own, so she is first generation, they would qualify because they're buying together. It's just only if only one borrower is buying by themselves, then that one borrower has to be first generation. So again, if there's multiple borrowers, only one borrower has to be first generation. So to kind of show you how the shared appreciation works, because this is something that the borrowers will have to think about. It's not as bad as what it seems, but they are having to share some of their appreciation. So we want to make sure they understand how that works so they can decide if this is the best program for them. So this is giving an example. If a borrower is buying a home for $500,000, I know in a lot of areas, sales prices are a lot more than that, but we like easy math. So just work with me. So 500,000 is what they're buying. So 20% is 100,000. So that means they're going to get 100,000 for their down payment. So their first mortgage loan amount is only 400,000. So this is what makes the program, a good program, is that it's giving the borrower a good amount for their down payment. So they're having a lower loan amount. So their payment's going to be a lot lower. And then again, if they put the 20% off for down payment, it avoids mortgage insurance. So with the first round, we were seeing people save $500, $600, $700, even $800, $900 a month on their mortgage payment because of the amount of down payment and the either reduction or elimination of mortgage insurance. So say in 5 years, the borrower decides they want to sell and now their home is worth $640,000. So that means their home appreciated $140,000. So they would just need to share 20% of that. So they got 20% for their down payment. The shared appreciation is a 1-to-1 ratio. So now they would share 20%. In this situation, that would be 28,000. So they would have to share 28,000. They keep the other 112,000 of what the home appreciated. Now, over that 5 years, we estimated that the borrower made about 30,000 in payments. So their monthly mortgage payment. So now their first mortgage balance is only 370,000. So they're selling the home for 640,000. Now they do in addition to the shared appreciation, they do have to pay back that 20% down payment. So that 100,000. So their total they would pay back is 128,000, but they're keeping 142,000 of their equity. So they still are getting to keep a good amount of their equity, but they are having to share some of it back. So that is something that they need to understand to make sure that this is the program for them. So if they're selling this house for 640,000, they pay 128,000 back. That just means someone buying the 640,000 would get that 128,000 for their down payment. So that's the whole idea of the program, is to work like our My Home program, where it's recycled funding, to where we can offer it every year. So once people pay it back, it goes back into the pot of funds. But right now, since most people are not going to pay this back right away, it's going to take years for us to get enough money to be able to roll the program back out. So we are reliant on the state every year to give us money. So it's just based on the budget, if the state's going to give us money every year. So it could take 5, maybe even 10 years before people start paying it back for us to get enough money to roll it back out. But that's the whole idea of the program, is for it to be a reoccurring program every year. Now, there is a max that the borrower will ever have to pay, and this will be in their disclosures that they sign. So it's 2.5 times the original loan amount. So in the example I gave on the previous slide, the borrower got 100,000 for their down payment. So the most they would ever have to share is 2.5 times that, which is 250,000, plus paying back the 100,000 they got. So for that scenario, the most they would ever have to pay back is 350,000, regardless of how much their home appreciates. Say they stay in their home for 20 years and now their home is worth $1 million or $2 million. They don't have to share 20% of that amount. So there is a max that they will ever have to pay, and they're going to know that up front. So based on what the loan amount they got, 2.5 times that, plus that original loan amount. So they're going to know up front what the max they will ever have to pay. Now, we are saying that this program is meant for someone who plans to buy a home to stay in for a while. And this chart is going to show this. So it's not meant for someone to buy in a year or two, they're going to sell. So it's meant for someone buying a home that they can stay in for a while. And it's meant for someone that no other program really is going to work. So we always tell everyone, you know, like I said, with the lenders, try to qualify them with My Home. Even though My Home only gives up to 3.5%, there's no shared depreciation. There's no first generation requirement. And also there's no lottery. So they can get that anytime long as they meet the guidelines. But like I mentioned in the beginning, with the high interest rates and the high prices, some people, this is their only option. They need a bigger down payment. So that's what this program is meant for. So this is based on if the home appreciated 4% every year. So the gray portion represents the first mortgage balance. The blue portion represents the equity. The orange portion represents the Dream for All. So you can see the longer the borrower stays in the home, their first mortgage balance goes down, their equity goes up, and then less they're paying to Dream for All. So they're keeping more of their equity than they are paying back to Dream for All. So you can see in the first couple years here, if they were to sell in the first couple years, they're paying back more to Dream for All than they are keeping their equity. So that is the benefit of owning a home, is building that equity. So Dream for All is not taking all of their equity, but you can see if they do sell too quickly, they are paying back more than the equity that they are keeping. But the longer they stay in the home, you see they're keeping more equity than they are paying back to Dream for All. And then again, they are going to have that max that they will ever have to pay back, no matter how much the home appreciates. So again, this is why we're saying it's meant for someone who's going to stay in the home for a while, so they can ride out the market cycles. These are all the pros, but the borrower needs to understand that there is one con in this. So the pros outweigh the cons, but they need to understand all the guidelines. Now, say they decide, okay, I'm going to get in this home and in 5 years, I'm going to sell it. And say in 5 years, the market is down. Now they owe more than what the property is worth. Now the home didn't appreciate, so there's nothing they have to share, but they still always have to pay back that 20% loan. So that is something that they do need to understand, that no matter whether the home appreciates or not, they always have to pay back that 20% loan. So the 20% loan, so in the examples I've been giving, it's 100,000. That 100,000 is a silent second, but there's no interest. So I always tell everyone, what bank are you going to go to that's going to give you 100,000 at no interest? So basically the interest is the shared appreciation. So, but if the home doesn't appreciate, there's nothing to share, but they always have to pay back that 20%. So this again is why we're saying this is meant for someone that can stay in a home for a while. So in that 5th year, if they wanted to sell and the values are down, could they stay in that home a little bit longer to be able to ride out the market cycles? We all know, I always say real estate's like a roller coaster. It's up and down, up and down. So it's always going to correct itself. So could they stay a couple more years till the values go back up? And then that way they're not losing money. So we just want to make sure they understand all of that. We're not saying that this should be a home that they live in for the rest of their life. We know first-time home buyers, this is probably not going to be their forever home. If it is, that is great, but most people are going to probably take a couple homes to get their forever home. So all we're saying is that it should be a home they can stay in for a while. So I always give the example of my personal situation. So the home I'm in now, when I bought it, I said, I'm only going to be in this home for 5 years. My daughter was in junior high. She was about to be entering high school. So I need to be in a certain school district. There was a new high school. The house was right at the back of the high school. It's perfect. She could walk to school. She played sports. So she could walk to practice. I didn't have to take off work to take her to practice. But I said, once she graduates high school, there's nothing keeping me in this area. I can go buy anywhere. Well, 15 years later, I'm still there. Because after high school, she went to college and now I had to pay for college. So I'm like, okay, I can't really afford to move because I need to pay for college. So now I'm just staying there. So now I'm trying to make it my forever home. So that's just the example I'm giving. Even if they have a set plan, oh, in 5 years, I'm going to move. If for some reason the values are down, could they stay a little bit longer just to ride out those market cycles? So that's what we're saying this program is meant for. It's not going to work for everyone, but we're telling borrowers to apply now through the lender to get pre-approved so they can see where they stand. You know, can my home work for them? Can a city or county program work for them? Or is Dream for All their only option? Then, you know, it's worth waiting, but we're telling our lenders and our real estate partners to make sure to set clear expectations for these borrowers, because like I said, it is going to be a lottery. So there's no guarantee that they're going to get selected. So that's what I had for you guys today. Here's my contact information. If anyone has any questions, they can reach out directly to me. Just know I travel a lot. So email usually works better for me, but definitely you can reach out anytime. And then I'm, available now to answer any questions that anyone has. I know I kind of went through all of that pretty fast, a lot of information, but didn't want to take up too much of your time. But if there are any questions, let me know. I can answer those.
Okay, I have a question actually. So you had mentioned earlier that there was classes that we can take as real estate professionals that can help either go over the down payment assistance programs or something. Can you elaborate on that? Because I thought there was even for the Dream for All, there was like a $50 class you could have taken, but I could be wrong. I could be mixing up the
Yeah,
organizations.
so for Dream for All, the borrower does have to take 2 homebuyer education courses. So the regular 8-hour course that is required on our regular programs, and then they have to take a second shared appreciation one. So that's the one I'm recommending to you guys to take, because it does go over how shared appreciation works. Because again, we want to make sure they understand before getting into the program. Because we don't want them 5 years from now, they go to sale and they're like, wait, I didn't know about this. So we want to make sure that they understand going in how the program works. So that is available on our website. It's free. It's about an hour. So that's the one I recommend all real estate professionals to take, because it does go over, similar examples that I just went over, but it goes into detail about how the shared appreciation works. So that's why we just recommend our real estate partners to take that course as well. Because I think that's kind of what happened with the first round. I think a lot of people weren't quite understanding how it works, and they just hear shared appreciation and they automatically think, oh no, it's taking my equity. So maybe people might have steered people away from the program because they really didn't understand how it works. So this way you understand how it works. So that way, if a borrower does have questions, then you'll be able to answer those questions.
Okay, great. We do have a couple of questions in the chat.
Okay.
What if a borrower refinances?
So we are allowing the borrower to refinance once without having to pay it back. Now, there are certain guidelines to be able to refinance to get the exception. So it has to at least be after a year. So they have to have made at least 12 payments on time. And I think it's going to be a very limited, basically a streamline. I don't think we're allowing any cash out or very limited cash out. And the interest rate has to be a certain percentage lower. So there are certain guidelines. So if they do meet those guidelines and they refinance once, we will subordinate. So we will not, require them to pay it back at that time or the shared appreciation. But after that one time, if they do refinance again, then it's due and payable at that time. So they would have to pay back the down payment loan plus share their appreciation.
Okay. All right, great. I have another question too. And
Okay.
just for clarity. Now, are everyone going to be qualified for the Dream for All program? Will they, if they don't qualify for the My Home program? Because I think I might have misunderstood. Like once they go in, if they qualify for the My Home, that would be the product that they probably will get, because you kind of want the Dream for All to be more for those who have an issue with the monthly payment. And I just want clarity on that.
Yeah, so because of the changes with Dream for All, and especially even if the borrower meets all of those change guidelines, because it's a lottery this time, it's not first come, first serve. So they could still meet all of the guidelines. This could be the best program for them, and they still not get selected. So all we're saying is when the borrower does apply through one of our lenders, we're just telling our lenders, take a look and see, can they qualify with My Home? Could they qualify with another program? Because Dream for All is not guaranteed. But if Dream for All is their really only option, then they pre-approve them for that, but they just need to understand that there is no guarantee because of the lottery system.
Okay, great. Does anyone else have any other questions for
Yes,
Leanne?
I do.
Oh, okay.
Thank you. And thank you for the present. I just want to clarify on the closing costs. Thank you for all this information. I have two questions. The first is, in your scenario, you mentioned a 5% closing cost credit from the down payment assistance. Is the max 5% for the closing cost? Or is
That's
that a
the
scenario?
yeah, that's the max you can use of the 20% to go toward closing costs is 5%.
Okay.
Is the max.
Okay. And then my second question is, thank you so much for sharing the information regarding first generation home buyers. So I feel like that was great progress there. Is there anything else that you see that may be still in conversation where we need to keep updated with the guidelines that may change before April?
As of right now, no, the guidelines are out and they are set. The only thing to keep a lookout for is the portal information. So we haven't announced that yet, the exact dates, when the portal is going to be open and it's going to have all the guidelines. So that hopefully by the first week of March is when we're looking to try to get that out, because the portal will open in April. But as far as all the guidelines, those are set.
Thank you. And I see we have a hand raised, Parisha.
Okay, they may
Dolores?
proceed. Dolores, go ahead.
Hi, you guys. My question is, how will you know who is a first time generational, their parents have not owned in the United States. How will you get that information to be accurate?
So they're going to be filling out information when they enter the portal. So there is a form. So we do have a affidavit. It's called our state reporting disclosure form. And we collect that on all of our loans. It's just not mandatory for my home. So they're going to fill out that form. And then also when they do their pre-registration in the portal, it is going to ask about first generation. So they're going to, attest to that if their parents own or not. Also, even, if they mark, no, my parents don't own, I meet the guidelines, we're still going to be investigating. So we do have a third-party investigation company that is going to be auditing all of the files to verify if their parents meet, the guidelines. So we are going to be checking that.
Oh, okay.
And it looks like you have one question in the chat. Is the My Home a silent second?
Yes, my home is a silent second. So they do have to pay that back when they sell, refinance, or in 30 years. But my home, we will not resubordinate. So like on Dream for All, where I said we'll allow them to refinance once, my home, we will not. So any refinance on my home, they do have to pay it back at that time. And then one other thing I want to mention too is that we will have a wait list this time. We didn't have that last time. And everyone that enters the portal is going to be notified. So there's going to be 3 statuses. So first one, congratulations, you got selected. Here's your voucher. Number 2, sorry you didn't get selected. Third one, sorry you didn't get selected, but you did get selected for the wait list. So that way, if any vouchers fall out, then we can go to someone on the wait list. And then also what I'm telling borrowers and lenders is if the borrower does get selected and they get that voucher, give a copy of the voucher to the realtor. So that way, when they put the offer in, the realtor can submit the copy of the voucher. That way the seller side knows they got selected. Because like I mentioned, we may have some agents that, what happened last time and they're like, oh no, I'm not going to accept any offers with Dream for All because I don't want it to fall out of escrow. So that way they know. And then I'm telling sellers agents, if you get an offer that says they're doing Dream for All, ask for a copy of that voucher. That lets you know that they did get selected for the program. Because we don't want a borrower to lose out on a home just because the seller side is afraid, because of what happened the first round. So they get that voucher, they're guaranteed the funding long as they still meet all of the guidelines. So that's one thing I want to stress too, because we announced these guidelines at the end of January, along with a copy of the pre-approval letter, and lenders are already rushing out day one. Oh, I'm going to fill this out, because they don't want all the rush coming in March, beginning of April, because everyone's going to be, oh, I need this, form filled out, because they can't enter the lottery until they have that pre-approval form. But what I'm telling lenders, they need to be careful because pre-approvals are only good for a certain amount of time. So we don't want them to pre-approve them, and then by the time they go find a home, that pre-approval could expire, and now they have to run credit again, and something could have happened, where their credit score drops. And since this is conventional financing, we know it's harder to qualify on conventional. So, which I know all lenders do this now, but they just really need to stress, tell the borrowers, don't go buy a car, don't go open any new accounts, don't run your credit cards up, don't make any late payments. Because on conventional, a current late payment, the lender may not be able to get a DU approval. So we're just stressing to our lenders, just be careful about doing the pre-approval too early. We don't, they can do it now, but they just need to be prepared to update it and make sure nothing has changed.
Okay, thank you, Leanne. We actually have LaTroy's hands up. Go ahead, LaTroy.
So my question is for the verifications, will that be done prior to closing or after closing?
You're talking about for the first generation?
For the first, yes.
Yes, so we're going to do that when we issue the voucher. So Once we do the selection and whoever gets selected for the voucher and the wait list, those are the ones that we're going to be auditing. So the goal is once the voucher gets issued to the borrower, we've already done our investigation. So that way we're not going to give someone a voucher and then say, oh, sorry, you didn't meet the first generation and pull the voucher back. So we're going to do all of that prior to issuing the voucher.
Okay, and so we have a couple questions in the chat. What would be the reason, and you may not know, but what would be the reason why they wouldn't be selected and not be selected on the wait list?
It's totally random.
Okay.
We're not going through saying, okay, we're going to select this borrower and not this borrower. It's totally random.
Okay, and then also the second question, is it already, the community percentages, has that already been determined? I know you said LA County may have 25%, but is there a way to go on the website and find out the actual percentages or?
We don't have that on the website. I'm not sure if we're going to announce that in the bulletin, but we did when we had our board meeting, and I can send that to you, and then that way you can send it out. But it's nowhere on our website. But it was in when we did our board meeting because we have to get everything approved through our board as well. So that was shared. So I can definitely share that with you.
Okay, thank you very much. Okay, so does anyone else have any additional questions for Leanne? This has been a wealth of information, a wealth of information. Rhea, would you have something to say before we close out?
Sure, definitely. First, I want to thank Leanne for taking this time to educate us. This is very valuable for our membership, and we will continue to share the information, of course, as we wait for the portal to open. So I think we're going to have to have a daily checker of someone who's making sure the portal is open. But thank you so much. I just want to let everyone know that we do have a couple of things coming up on March 5th. Don't forget, we have our Prospecting Tuesdays where we're dialing for dollars. This month in March, of course, we're going to get on the lines and tell everyone we know about the California Dream for All and how to get prepared for that, right? So that's on our every first Tuesday of the month. And then we have an online membership mixer. So we're going to have a speed mixer. How that works online is we are going to have different breakout rooms, and then you're going to just basically transfer from room to room. There's going to be a DJ. We're going to have some raffle prizes. We have Uber Eats vouchers for the first folks that are on the line. So it's a really exciting time to get to know your members across the state of California. And I look forward to everyone attending in that. Thank you, Parisha.
All right, thank you very much. Everyone have a great rest of the day, and we'll see you for the next Power Hour in about 2 weeks. Benefits of being a broker. Talk to you soon.